Thank you for joining us this evening. It's Thursday at 7 p.m. Eastern. Thank you for joining the Real Estate Accredited call. It's a weekly call that is about education for either active or passive investors in commercial real estate and more particularly multifamily, in-place multifamily value-add real estate. All right, so tonight we're going to talk about building a diversified real estate portfolio, again, in particularly with the focus of commercial multifamily value add, but also looking at other asset classes in the commercial real estate area. So tonight I'm with my co-host Chris Price, who recently joined us in our fund. Chris, you want to say hello?
Hello, everybody. Thank you very much for welcoming me. I'm looking forward to getting to meet all of our investors and bringing you great real estate opportunities with Philippe and Jeff.
Thank you, Chris. All right, so building a diversified real estate portfolio. And let's start with the basics, right? What do you need when you invest in real estate? I think several factors that you need to consider. Number one is pertains to the general strategy, meaning what asset class are you going to invest and what kind of business plan. So for instance, is it self-storage? Is it multifamily? Is it ground up? Are you going to just buy land and develop the particular asset, or are you buying something, an existing asset in place where there is a value add component, for instance? The second piece of that is going to be a discussion about which markets you're going to look for deals into and establish in those markets deal flow, meaning talking to brokers and to have sufficient deals, opportunities that come to you that you can underwrite and then pursue and make offers. And finally, the last piece, and that's obviously for the active investor side, is going to bring the capital to close on that particular deal. You look at multiple investments in a real estate portfolio, and here we have an example of some of the past deals that we were involved in, and some of them did the full turn. Some are still ongoing. But so asset classes, and that's what I just mentioned, multifamily, self-storage, short-term rentals, those are different examples. You have to understand from that standpoint, it takes skills to understand and master the different asset classes. But similarly, the business plan, because I mentioned ground up development earlier, and I mentioned value add. There are also some nuances. Core means it's an in-place asset that is very recent. That would be a core type of business plan, so cash flowing asset. Typically, something that REITs would purchase looking for cash flowing assets. And then you have all kinds of in between because for example, the core plus business plan is in between core and value add. And otherwise, another kind of approach is what is called opportunistic. And that would be typically an asset that is distressed, where very low occupancy or where there is a heavy lift in terms of renovations to be performed in order to add value. And basically, from that standpoint, from a business plan standpoint, when you go from development, there's nothing to an existing cash flowing asset, very recent, the risk goes decreasingly. So high risk on development and low risk on core assets. And that's why, depending on these business plans, you're going to have different type of returns. Finally, the market locations. Some examples there. Obviously, you want to focus on markets that have growth. That's what we do. It's basically our number one criteria. We're looking at a high population growth in the different markets. I gave some examples here. Georgia, Texas, Arizona, those are all markets that have pretty consistent growth throughout the markets. But in terms of challenges and tips, cost associated to learning the different asset classes, learning the different business plans, and learning the different markets. Each time, that's why we focus right now on multifamily. That it is our core asset class that we like to take care of. That's something I've been involved since 2017. Myself, my partners as well, they've been involved in multifamily for several years. And we're still learning nuances and the asset class every day because the market is changing. At some point, we had very low interest rates, and there was a strategy to do deals in that environment. Now it's a more higher interest rates, so it's a kind of a different strategy we have to look at. And the market is always constantly changing. And same thing applies to the for the different markets. It's better to be focused on one market. That's why we pick our partners that are very focused on very specific markets. And also the business plan, like I mentioned, development, high risk, high returns, but high risk, core, low risk, low returns. Now we like the value add. Value add is very interesting because usually you have a cash flowing asset, but you can do better. You can do renovations. It's a very simple business plan. And that's why we like that business plan. In order to be proficient in the asset class, in the business plan, in the market, you really have to stay focused. So tip number one, stick to one asset class, market, and business plan to become proficient. Now, this is true, I think, for active investors as well as passive investors. The second tip applies more for active investors, obviously. So here, the idea is if you want to expand to another market or start looking at a different market and you're very satisfied with the property management you're using, then if they are already implemented in a different market, then you can use leverage that expertise that they will have developed in a particular market to consider that market as well. Next, I think, and that's another consideration to have, and it's true for both active and passive. Again, let's look at the high level deal life cycle. Right, from a passive investor view, you will become aware of a deal prior to the acquisition when the capital is being raised. Then, during a period of 3 to 5 years, you'll see the business plan being executed, corresponding to sometimes what is referred as stabilization. There might be an optional refinance year 2 or 3, and eventually disposition of the asset. And usually that's where, towards the end, there's a lot of the profits will be made in a value add type of business plan. From an active investor view, you're going to see obviously the same things, except a lot more time spent on deal finding, underwriting, submitting LOIs, letter of intents, and running the acquisition due diligence. So what does that mean is when you're going to look at multiple deals that you're going to run in parallel, you're going to have to consider the what kind of bandwidth you have really to be able to handle multiple deals at the same time. So usually what happens is you're going to have an acquisition team who will focus on this early stage deal finding, underwriting, submitting LOIs, and then running the acquisition piece. That's where really there's a handoff between the acquisition team and the asset management team. And then the asset management team will oversee the business plan execution up to disposition, right? So now you can do one deal at a time. I would say probably here, just in the deal funding underwriting, you're going to do multiple underwriting and submitting LOIs and doing research and whatnot per week. It's going to take probably 100 deals that you're going to study to be able to secure one, then you have to dimension your teams accordingly. So there you go. So the challenge is the workload bandwidth of the acquisition team and the asset management team. And sometimes it's a solo team. That's how you start usually. So you have to start when you see that you're reaching capacity, you have to start delegating responsibilities. Could be to virtual assistants or other third parties who can do underwriting, for instance, and just carry on with building a team and having staff who are going to take these tasks and take care of these tasks. And then once you have, you're going to design procedures and make sure that the different team members are following these procedures and producing key indicators that you can review and make sure that everything is going smoothly. And then it's a matter of scaling the team down the road. And so that's one way to be able to grow. The other way is really like to avoid, if the acquisition team is going to focus on one acquisition, don't have two of them at the same time. That's going to be very challenging. And that's where you start doing mistakes. So if you can imagine you keep this first acquisition here, and then just one of the two below that, so you avoid having people doing too many, taking care of too many new acquisitions at the same time. Sometimes it's easier said than done, but that would be the obvious second tip there. So from an investor standpoint, you're going to look at how many investors you have in your pool of possible investors and keep the pulse on what they can do, how much they can invest, are they ready to invest, is that, and then just let them know that there's something new coming up. Aware, obviously, there are numbers of factors affecting investors, ranging from how much funds they have to invest. They could be family events and also market conditions that are going to affect their ability to invest in particular deals. The challenge is going to be, in that case, the financial bandwidth of the investor list. Like I said, keep the pulse, just stay on top and have discussions with them to understand where they stand, how much they can invest. And tip number two, I think the raising part is you're going to always be raising. Any opportunity, any new people that you meet, any event that you attend, we can talk about what you're doing and build up your investor list. But also, I think when you're targeting a larger acquisition, you can build a list of other capital raisers or other capital raising partners who can work with you. So that's all I have for tonight regarding the building a diversified real estate portfolio. As always, you can reach out to us. Here are our emails for Jeff and I, and I will open the floor for any questions. Carl, I don't know if you have any question. No, you're busy.
One question: have you guys done any ground up new developments at all, or no?
No, we've looked at some of them. I wasn't that it sounded good and I wasn't like the team didn't seem to have or the teams didn't have enough experience in my opinion of doing things together. And I know there's one particular other syndicator that I will not mention who was doing some ground up and he ended up putting that on pause because of the higher interest rates. So actually that's also because you're doing construction loans and obviously any business plan that was drawn or drafted a couple of years back, now that you have a hard time to execute. Like I said, it's usually higher returns, but cash flow is delayed and but higher risk. So that's why we prefer in place. Let me know if you have anything else, Carl. If not,
No, I don't have any other questions for
Okay.
tonight.
Thank you for joining us. I know shorter call tonight. Going to jump over Chris's meetup there. And yeah, thank you again for joining us. Hope it was useful and make sure to join next week. All right, have a good evening.
All right,
Take
we'll
care.
do. All right, you too.
Bye bye.
Thank you.